The United States tax code is roughly 7,000 pages long. If you want to find the section that actually tells you how much money you owe the government, you only need to read about 2% of it. The remaining 98% is something else entirely. It's an instruction manual. The government is essentially handing you a massive published shopping list, detailing exactly what they need built, and offering to pay you if you help them build it. Most of us are taught a very specific, predetermined path. You go to work, you earn a paycheck, the government takes a slice right off the top, and you try to live on whatever is left over. That is the path of a consumer, and the tax code is incredibly harsh on consumers. But the government functions a lot like a massive business. They need infrastructure. They need housing for citizens, energy to power the grid, and new technology. They cannot build all of these things on their own. So they created a parallel path for owners and investors, rewarding the people who step up to finance those massive projects. Wealthy individuals paying low taxes are following the explicit instructions found in that 98%. They buy exactly what the government needs and collect the public subsidies offered in return. To take advantage of this, the government uses a tool called bonus depreciation. You can think of it like an income eraser. This visualization shows a starting taxable income of $100,000. When you buy a qualifying asset, say for $50,000, the government lets you cross that exact amount off your income ledger in year one. Your recognized income instantly shrinks down to $50,000. You aren't getting a bag of cash handed to you. Instead, you are hiding a large portion of your earnings from the IRS's tax math. You only pay taxes on the smaller leftover amount. The second tool is even more direct. It's called a tax credit. If depreciation is an income eraser, a tax credit is a literal dollar-for-dollar coupon applied at the cash register. Looking at this comparison, you see a final tax bill of $10,000. A $10,000 tax credit applies directly to that amount, erasing the balance entirely and bringing your payment down to zero. Once you understand how these two tools work, April 15th stops looking like a penalty. Instead, the tax code becomes a major upfront discount program to help you buy income-producing assets. So what is actually on the shopping list? First, we have Bitcoin miners. The IRS classifies these physical computers as capital equipment. You can write off the entire cost of the machines in year one, while the machines sit on a shelf and produce cryptocurrency for you every single day. It offers a high technological reward, but it comes with the volatility of the crypto market. The asset's daily output bounces around as the global price goes up and down. Second on the list is oil and gas. Energy independence is a massive priority. When you invest in a drilling operation, the IRS allows you to deduct the labor, fuel, and site preparation, things they call intangible drilling costs. This lets you write off up to 90% of your investment immediately, while securing a stake in a producing energy well. Third is real estate. By hiring a specialist to break down the cost of a building's carpets, appliances, and fixtures, a process known as cost segregation, you can pull decades of normal wear and tear deductions into year one, creating a massive upfront tax shield. Real estate is uniquely tangible. You can visit the property, use it yourself, rent it out to generate monthly cash flow, and watch the physical land go up in value over time. Finally, we have solar. Because of current federal clean energy targets, the government is highly motivated to get solar panels installed. This makes it an incredibly accessible entry point. Solar gives investors a rare double benefit. You receive a direct 30% tax credit coupon, and then you are still allowed to use the depreciation eraser on the remaining 70% of the system's cost. You might prefer the tech upside of Bitcoin, the physical reliability of a rental house, or the immediate heavy discounts of solar energy. Regardless of the path, the result is the same. The government is subsidizing your entry into wealth creation. There is a mechanic that makes all of these plays work, and it removes the biggest hurdle most people face. You do not need to drain your own savings account to buy these assets. You can use other people's money. This flowchart illustrates a bank loaning $100,000 to buy a solar array. Because your name is on the asset, you still get the full tax deduction, even though the bank's money paid for it. In many cases, the massive tax refund you get back from the IRS in year one is enough cash to comfortably cover the monthly loan payments you owe to the bank. Using a financing strategy completely changes the math. It allows you to acquire valuable, income-producing assets while putting very little of your own personal cash at risk. This strategy only works if you respect the money it generates. A consumer takes a tax refund and buys a television or goes on a vacation. An owner traps that money in a compounding cycle. You acquire an income-producing asset using financing. You get a massive tax refund. You take that refund and immediately use it as the down payment on your next asset, which generates an even bigger refund next year. The cycle repeats, building momentum over time. To get started, you need to take 3 steps. First, look at your pay stub and calculate how much money you are currently losing to taxes. Second, look at the government's shopping list and pick a starter asset, like real estate or a solar installation. Third, take that plan to a tax professional. Specifically ask them how to structure a bonus depreciation strategy for the asset you chose. The instructions for building wealth have been sitting out in the open for decades. It is simply a matter of reading the code, providing what the country needs, and deciding to finally play the game as an owner.